Over the last year, I've been doing something that I think most people in their late 30s should be doing, but almost nobody does, which is mapping out what I actually need to have figured out before I cross into the next decade. The exercise started because of a conversation with my friend Pete, who I've talked about on this channel before. Pete is 51 now, and he told me, almost in passing, that the financial decisions he wishes he'd made differently weren't the big dramatic ones in his 50s. They were the small administrative ones in his 40s that he kept putting off until they couldn't be put off anymore. Things like updating his life insurance, getting his will done, sitting down with the actual retirement math instead of guessing. He told me, "Tom, the 40s are when the bill comes due for everything you didn't handle in your 30s, and the 50s are when it gets harder to fix." That comment is what produced this video. I went and did the research, talked to several people I know who are deeper into this decade than I am, and put together the list of milestones that came up consistently across all of them. I'm Tom. This channel is about real personal finance, the kind that actually works for normal people instead of the kind that gets you to click on a thumbnail. No motivational fluff, no fantasy returns, no get rich quick. Just what the math actually does over time. If that's what you want, hit subscribe. Today I'm going to walk you through the 6 financial milestones I think every person needs to hit during their 40s, in roughly the order they should be hit, with the actual benchmarks that tell you whether you're on track or behind. Some of them are about money you should have. Some are about decisions you should have made. All of them have a window that closes in your 50s, and trying to fix them later costs significantly more than fixing them now. Milestone 1, the Honest Net Worth Audit. The first milestone is the one almost nobody actually does, which is sit down and calculate your real net worth on a single sheet of paper. Not your gut feeling, not the dashboard in your Mint app that usually misses your mortgage and your car loan. The real number, with everything you own minus everything you owe. The reason this matters more in your 40s than in your 20s or 30s is that your 40s are the first decade where your net worth actually starts compounding meaningfully. Earlier in your career, your net worth is mostly noise. The trajectory hasn't established itself yet. The numbers are small, and small percentage moves don't create real wealth. By your 40s, the trajectory you're on becomes the trajectory you'll likely be on at 60, and any course correction you need to make is dramatically easier in this decade than the next one. Here's the benchmark that tells you where you actually stand. Per the latest Federal Reserve Survey of Consumer Finances, the median household net worth for Americans 35 to 44 is about $135,000. For 45 to 54, it's about $247,000. If you're in your 40s and somewhere in that range, you're at the median. Above it, you're ahead. Below it, you're behind. That's the basic geography. The more useful benchmark from the Stanley and Danko Millionaire Next Door research is that your expected net worth at any given age should equal your age times your pre-tax annual income divided by 10. If you're 45 and earning $80,000, that formula gives you $360,000. People who hit that number are what the research called average accumulators of wealth. People who hit twice that number, $720,000 in this example, are what the research called prodigious accumulators. Below that number is underaccumulator. None of these are judgments, but they tell you where you actually are versus where someone with your income trajectory could realistically be. Run the calculation tonight. The exercise itself takes maybe 20 minutes. If you've never done it, the result is going to surprise you in one direction or the other. And either result is useful information for the next 5 milestones. Milestone 2, the retirement trajectory check. Once you have your net worth, the second milestone is to figure out whether the trajectory you're on actually gets you to retirement, not in vague terms, but in specific numbers. The benchmark Fidelity uses, which is rough but useful, is that you should have 1 times your annual salary saved by 30, 3 times by 40, 6 times by 50, 8 times by 60, and 10 times by the time you stop working. So at 40, with an $80,000 salary, you should have around $240,000 in invested retirement assets, separate from your home equity. At 45, that same person should be at 4.5 times their salary, around $360,000. At 49, closer to 5.5 times, around $440,000. If you're significantly under those numbers, the most important math you can run is not how do I catch up? It's what does my realistic retirement actually look like, given where I am? I made a video on this channel about the $1,000 per month rule that walks through exactly how to calculate your real retirement target, which, for most Americans, is dramatically less than the $1.46 million the Northwestern Mutual surveys say everyone thinks they need. The honest answer is usually that you're closer to a real retirement than you think, and the gap to close is meaningful, but not catastrophic. The action item for this milestone is to know your real target, not to panic about whether you'll hit it. Milestone 3, the term life insurance decision. This is the milestone that almost no one in their 40s has actually thought through carefully. And it's the one where the cost of getting it wrong is enormous and immediate. If you have anyone who depends on your income, which usually means a spouse who shares expenses with you, or children who need to be raised, you need term life insurance, and you need a specific amount of it. The standard rule is roughly 10 times your annual income, with a 20-year term that covers you through the highest dependency years of your kids' lives. Per LIMRA's most recent industry research, 41% of American adults either don't have life insurance or don't have enough of it. And that gap is concentrated heavily in the 35 to 50 age range, which is exactly when the need is highest. The reason most people don't have it is that they assume it's expensive. It isn't. A healthy, non-smoking 40-year-old can typically buy a $500,000 20-year term policy for about $25 to $40 a month. A $1 million policy is usually $45 to $70 a month. That's less than most people spend on streaming subscriptions. The reason term life insurance becomes urgent, specifically in your 40s, is that the cost goes up substantially every year you delay, and your insurability can disappear entirely if you develop a health condition during this decade. The best time to buy a 20-year term policy was last year. The second best time is this year. The worst time is after a doctor's visit that produces a new diagnosis. If you don't have adequate term coverage and you have dependents, this is the milestone to hit before any of the others on this list. I want to be specific about what this is not. Term life insurance is not whole life insurance, and it's not a savings vehicle. The whole life products that get marketed aggressively to people in their 40s are almost always wrong for the buyer. They cost 5 to 10 times what term costs for the same death benefit, and the investment component returns less than a basic index fund would. The product to buy is term. The duration is 20 years, and the amount is roughly 10 times your salary. That's it. Milestone 4, the estate planning basics. This milestone is closely related to the last one and almost equally ignored. Per the Caring.com 2024 Wills and Estate Planning Survey, only 32% of American adults have a will. 68% of the country has not put in writing what should happen to their assets, their kids, or their healthcare decisions if something happens to them. In your 20s or 30s, that's defensible. The complexity is low, and the consequences of dying without a will are mostly inconvenient. In your 40s, when you have meaningful assets, possibly children, and parents who are starting to age, the consequences of not having basic estate documents in place become severe. The basic estate documents that almost everyone in their 40s needs are a will, a healthcare directive, a durable power of attorney, and updated beneficiary designations on every retirement account, life insurance policy, and bank account. The total cost to get all of this done, working with an estate attorney, is typically $400 to $1,500, depending on complexity. There are also online services like Trust and Will or LegalZoom that can produce basic versions for $200 to $500 if your situation is straightforward. Either way, the cost is small relative to the consequences of not doing it. The piece of estate planning that almost everyone gets wrong is the beneficiary designations on retirement accounts. The beneficiary form on your 401k, IRA, and life insurance policy overrides whatever your will says. If you got divorced 10 years ago and never updated the beneficiary on your 401k, your ex-spouse will inherit it, regardless of what your current will says, regardless of what you intended, regardless of how unfair that outcome would be. Updating these forms takes about 15 minutes per account and is the single highest return administrative task most 40-somethings can do. Milestone 5, the college funding trade-off. If you have kids, this milestone is probably the most emotionally fraught decision of your 40s, and the one where the most well-intentioned parents make the most expensive mistake. The mistake is funding their kids' college from money that should have been retirement contributions, in the name of being a good parent. Here's the math. Per the College Board's 2024 data, 4 years at an in-state public university costs around $112,000 today, and that number is rising at roughly 4% per year. 4 years at a private university is closer to $240,000. If you have one kid heading to college in 10 years, and you decide to fully fund a public university, you're looking at saving roughly $1,000 a month for 10 years. With 2 kids, that doubles to $2,000 a month. The temptation for most parents is to redirect that monthly amount from retirement contributions because the college bill feels more urgent. Run the opportunity cost. A 42-year-old who diverts $2,000 a month from their retirement to a 529 plan for 10 years gives up about $720,000 of compounded retirement wealth by 65, assuming a 7% real return on the redirected money. Their kids end up with college fully funded. The parents end up with a meaningfully smaller retirement, possibly to the point that the kids will have to support them later, which often costs more than the college funding ever saved. The correct order of operations, and the one that almost every financial planner agrees on, but parents have a hard time accepting, is to fund retirement first and college second. Your kids can borrow for college. You cannot borrow for retirement. Federal student loans for an undergraduate degree are capped at $31,000 total, which is less than a third of even a public university's total cost. But combined with reasonable scholarships, work study, and family contributions during college, it's enough that most middle-class kids can finish public university with manageable debt. The version of being a good parent that ends with you running out of money at 80 and asking your kids for help is not actually being a good parent. The alternative, where your retirement is secured and your kids carry $25,000 of student debt, is mathematically and morally the better outcome. If you want to fund some portion of college, the right amount is whatever's left over after you've maxed your tax-advantaged retirement accounts, including catch-up contributions where applicable. That's usually less than parents want to contribute, but it's the amount that doesn't compromise the rest of the plan. Milestone 6, the peak income decade. The last milestone is not a number to hit, but a window to use. Per BLS and SHRM compensation data, the average professional's earnings peak somewhere between 45 and 55, and either plateau or decline meaningfully after that. Your 40s are, statistically, the highest earning decade of your working life, and the actions you take during this decade have outsized impact on the wealth you'll have at retirement. The specific lever this opens up is savings rate. The same person who saved 8% in their 30s because their income was modest can usually save 18 or 20% in their 40s without any change in lifestyle because their income has grown faster than their fixed expenses. The mistake almost everyone makes is letting lifestyle inflation absorb the income growth instead, which produces a person earning twice what they used to and saving the same amount. I had a friend named Eason, who I've talked about on this channel before, who walked into his peak earning decade and let almost the entire raise dissolve into a series of upgraded cars, a bigger house, and a lifestyle his 30s self wouldn't have recognized. By 41, he was earning $95,000 a year and saving roughly the same dollar amount he'd been saving when he earned $55,000. The income lever had fired, but produced no wealth, because the savings rate didn't move with it. The opposite version of the same person, who holds lifestyle close to where it was at 35 and routes the raises to investments, ends up with somewhere between $400,000 and $700,000 of additional retirement wealth by 65, depending on the magnitude and duration of the raises. That gap is what the peak earning decade is for. The action item for this milestone is to set a specific rule for what happens to the next raise you receive. Decide before the raise lands what percentage goes to investments and what percentage goes to lifestyle. A 50-50 split is more conservative than most people would think, and it completely transforms the trajectory. The raise stays partly yours, but the saved portion compounds for the next 20 to 25 years and becomes real retirement money. The lifestyle inflation portion at least stays bounded. If you're in your 40s and watching this, the rough order to actually accomplish these milestones is roughly the order I gave them. Do the net worth audit this weekend. It takes 20 minutes. Run the retirement trajectory check next, because you can't make decisions about the other milestones without knowing where you are. Buy term life insurance this month if you have dependents and don't already have adequate coverage. Get a basic will and beneficiary update done within the next quarter. Have the college conversation with your spouse before your oldest kid hits high school. And set the savings rate on the next raise rule before your next compensation cycle. None of these milestones requires you to be wealthy to hit. All of them require you to take an afternoon you'd otherwise spend doing something more enjoyable, sit down with the actual numbers, and make a decision. The 40-year-old version of you who does this is the same person as the 50-year-old version, with the same income and the same career. The only difference, 10 years from now, will be that the 50-year-old version of you is making decisions from a position of genuine financial security, instead of trying to figure out what should have been figured out a decade earlier. Drop a comment with which of the 6 milestones you've already hit and which one you've been quietly avoiding. I read every comment and I'll reply to as many as I can. And if you want me to walk through the same kind of milestone breakdown for your 50s, which is genuinely a different conversation with different math, hit subscribe, because that's the next video. I'll see you in the next one.